Hello, everyone, and welcome to a very special episode of the Property Trio. We're talking market update, so April 2024. And of course, as a bonus, the budget happened last night. So that's not yet necessarily feeding into all the data. Of course, bond yields and those sorts of things have reacted to it, but we'll disseminate that and the April figures with my lovely co-host David Johnston and Kate Bakos. Good morning, guys.
Good morning,
Mike.
Mr. Mortlock.
Or afternoon or evening to you listening at home. So it's 15th of May as at the time of recording. We're looking at April data. The first thing that I want to bring up with you, Kate, is that last month we were sort of talking to your prediction in and around Melbourne saying, look, it just hasn't hit the data yet. But interestingly, we were talking to a finance guru and an accountant yesterday, and there is quite a lot of buzz around Melbourne, but for the month, down 0.1%. Really
Yes.
nothing, but it's amazing just looking at the numbers as Melbourne kind of stays in the doldrums and everywhere else gallops along. It's getting to the point where people are starting to see some value.
Well, I conceded defeat, as you might both recall, this time last month. And I'd gone on the record saying, we'll see it in the data, and we're not. However,
Not yet.
Not yet. Now, Melbourne is getting a little bit of airplay because of a few things. I don't know if you've both been noticing, but I've seen a few variants of the property clock floating around. So typically it's the Heron Todd White one, but a few other organisations have developed their own property clocks as well. And in all of them, they're showing that Melbourne's past its bottom and it's in early stages of recovery. Now, people will pounce onto that. What I've been noticing is opportunistic buying. So I've had a lot of Sydney siders coming to Melbourne to buy because there's obviously a huge value differential and they're looking at the disparity. I've also seen some really clever charts, and I'll drop this one in the show notes, where we've had a look at how each capital city benchmarks against the average Australian house price. And so your average capital city price versus the Australian house price, there's a traditional line of differential. And so, for example, Sydney is, I believe it's 29% above the national average, and then Melbourne is typically running at, I think it was around 5. And so all of the capital cities have had their position of parity as against the Australian average. And Melbourne is showing that it's markedly down. But when you also look at Adelaide, Perth and Brisbane, Perth is showing that it's come back to parity, so it's recovered, but Adelaide and Brisbane are showing that they're overheated. And I'm not suggesting that one measure is a good indicator of an overheated market, but when we look at all of those things in tandem, it certainly explains the interest that Melbourne's getting from our interstate friends.
I think, we were talking to Pete Wargent last night, and he kind of reminded us that it moves in cycles. We're not going to have a national vacancy rate at 1.1% for the next 10 years. Eventually, things have to move. And, Melbourne just can't continue to become more and more of a value play and people not jump into it, right? So I wasn't meaning to hold you account. I believe you. I feel for you that we haven't seen it in the data yet, but we might only be a month or two away. I think there's going to be a real shift. And Dave, the perennial performer, Perth has hit 2% growth for the month of April. What do your aunt and uncle say about that?
Look, I mean, Perth's on fire and it has a lot of things going for it. And I think, that's going to keep playing out for a little while yet. And then it'll be interesting. I have a vision of a balloon when you let the air out of it and it goes flying around and deflates rapidly. I think we tend to have that boom and bust cycle of Perth and mining, and I suspect that's going to happen again with the Perth property market. But yeah, look, I mean, I'm being let off the hook a fair bit. I think I said about 3 or 4 months ago that Melbourne was showing a lot of signals that it was time to get back into Melbourne, and even before Kate went on the line with her comment a couple of months ago about Melbourne. So I still think that's the case, but Melbourne certainly has its challenges with its government debt, and there's still a bit of a stigma about the lockdown. So it is
I
a bit
think
of a
land tax is that big killer for a lot of people.
land tax, the perception of land tax, even though the reality of the increase for the average, property investor is not a significant sum of money. I mean, but yeah, it is a bit of a pariah state. And, I think often what we find is when we're making predictions, the prediction is often 12 months too early. So, it comes through 12 months later. But the savvy people, get in when it's early in the property clock, not when it's, dingling,
Yeah,
on
you're
midnight or
absolutely
5 minutes
right.
to midnight. Or Perth, it's 2 to 3 a.m. and, people are starting to head home, and some have stopped drinking a couple of hours ago and already feeling a bit hungover.
I love this analogy. I had someone ask me just this morning, should I be waiting? And I said, well, what are you waiting for? Because they want to buy in Melbourne. Well, we could wait for the market to improve. I said, well, you could, but you'll also be waiting for more competition and prices being higher. So that's something that you've got to decide. I mean, we all would love to think that we buy when it's a horrible, flat, dead market, and then the very next day things pivot. And it's very hard to pick how long you'll have to hold something in a flat market. But it's certainly flat. So I do see the opportunity. I understand why people are looking at it. But to the land tax point, what's been interesting about all of the interstate investors I've been working with and talking to is their price points are lower than what they've historically been. So people are weighing up the land tax issue, and they're looking at, if it's a house, I'm getting a fair few more that are looking at gentrifying areas and sub-$1 million budgets. In fact, I'm even working with someone with a $600,000 budget who's buying a house in Melbourne. And you've got to then have an open mind about the areas that you're targeting and the demographic that you need to cater to and the property management that you need to have in place, because you're dealing with higher crime, higher risk, lower incomes. All of those things are very worthy conversations. But I've definitely noticed lower price points, and I don't want to speak too soon. The next chart will talk to that.
I always kind of think, let's say Melbourne does 10% in the next 12, 24 months, what have you. If you're waiting for the green shoots, and it does go from 0 to 10%, you might be saying goodbye to 3 or 5% of that by waiting to see the green in the data. I think, if you've got the confidence to move on the fundamentals when the market is not showing any signs, that's where you maximize that upside. I think everyone can invest in property when they know that it's turned around and it's gone green, but it's a safe way to do it. It's not a good way to do it, say, with Perth. Wait until it does 2% in a month.
Yes.
Because it's, the argument is that you really should have bought in 2019 rather than today. And maybe Melbourne is the 2019 of Perth at the moment.
Who knows? I was listening to a very clever and short podcast from Stuart Weems at Investopoly, and I think it might be his very latest one or last week's, talking about Melbourne specifically, and it was really interesting. But I also note that I've got a natural bias and a longing for Melbourne to do really well, and I think it's fair for Dave and I to both acknowledge that.
I think it's also important we don't be too Melbourne centric in our conversations on the podcast. And look, I have a bit of a less bias because I'm not actually buying property in Melbourne. And so I don't have as much of a vested interest. I mean, we help our clients buy all around the country. We provide property plans that have location agnostic. So, but if you look at Brisbane, for example, in terms of other price signals, Brisbane's median unit price just overtook Canberra in the last month. And it's now approaching Melbourne's median house price and unit price. So it's only 13,000 under the unit price and 20,000 under the house price. So the questions we need to ask ourselves are: do we think Brisbane will become more higher priced to get into than Melbourne in the long run, despite its population size being significantly smaller? At this stage, certainly having less major companies and corporations based in that city. Now, I think most sane people would say that's unlikely, but so therefore, there's probably some pretty solid signs there that Brisbane's starting to hit a point of overheating to one of those graphs or calendars that you were talking about before, Kate.
Yes.
Yeah, let's go to units in the 3 months to April. The only capital to record higher growth in houses rather than units was Hobart, and it's marginal. But you look at the graph, Brisbane, Adelaide, Perth, really standouts to say that units are outperforming houses. And of particular interest to me was Brisbane. And I recorded a podcast on a different show with a Brisbane buyer's agent who basically said huge potential for units in blue chip locations because the price differential between a house and a unit is now over $1 million in many of these places.
Wow.
And you can kind of see that really borne out in the data that those units are getting dragged up, and it is an opportunity for people that don't have $1 million, $1.5 million to buy a house in some of these locations. So it's not often that we see units outperform houses, certainly over the long term, but that little blip is seeing them kind of get a little bit closer together.
Yeah, and look, if we come back to this chart that I talk to occasionally, Brisbane only has 25% of its properties as units, whereas somewhere like Melbourne is 34%. So there are less units to purchase, which is going to put more price pressure on them in a time where affordability is feeling, people are feeling the affordability pinch, and so they're looking more closely at units, and there's less of them in Brisbane proportionately.
Do you think also, Kate, the fact that there hasn't been a lot of new high-density unit projects coming onto the market really nationally is kind of weighing into that as well? Because the units transacting are probably going to be more established ones that have perhaps a bit more investor potential?
Yes, I think for the first time in a long time, we're using the word scarcity value with units. Not all of them, but they were a dime a dozen, especially in overcrowded cities like Melbourne, where we just had such an oversupply. There's a lot of reasons why units are reigning. We've got investors who are keen to keep investing but have cash flow constraints because of interest rates, so they're looking for stronger yields. We've got borrowing capacity constraints for buyers entering the market, and we've got a lot of excited first home buyers who have some really great initiatives that they can grab hold of, and stamp duty concessions, and they're circling them as well. And obviously with the call to come back to the office, a lot of people are looking at how they can get something comfortable a bit closer in to save their commute. And in addition, we've had, especially down here, a lot of sea changers and tree changers who have decided to get their bolt hole in the city and hold their country or coastal pad. And so we've had an increased amount of interest in apartments.
Let's have a look at regionals versus capitals. If you look at the graph, we saw probably the capitals outperform the regions for really probably the last 12 months, but we're now actually seeing the regionals slightly overtake the capitals. Do you think, we've talked about this ad nauseum, but have we settled that COVID impact where people buggered off to the regions and now they're sort of getting pulled back to the capitals? Have we reached a kind of like a stasis point where it's a bit more of a normal read?
It's a great question, Mike. There are some markets where the impact of COVID and that escapee move that we saw wasn't as great as other areas. And I know Dave just said not to make it too Melbourne-centric, but we saw a lot of COVID escapades in Melbourne for obvious reasons. And of course, the other lockdown cities were impacted as well. But we've already had decentralisation, and we've had a lot of people pre-COVID pushing for work from home hybrid arrangements. And now we've all proven that we can be trusted and we can do it. It's a lot more mainstream. So I think in a lot of markets, the regional's been embraced and it's not necessarily going to diminish. But I certainly saw down in Vic, our regions came off, and they've stabilised now, and I'm feeling encouraged that there's been a little bit of growth. And from an opportunistic point of view, I'm seeing a lot of investors targeting regions because there is perceived growth and market timing is looking pretty decent, and also the yields are up.
Yeah, I think it's still too early to tell whether or not it's back to this is the new norm with regions moving at the same pace of capital cities. It's probably still got a little longer to shake out, and that might be a few years as whatever becomes the ongoing norm for the working from home phenomenon. I think we need to test when unemployment rises another, percent or 2% to see if that changes things. But I feel like if I was betting, I would say this is possibly the new norm because, it certainly is much easier to work from a regional centre and from home and have that sort of longer distance commute to, from a nearby regional centre to a capital city if you need to.
Not all regions are created equally, of course, and we saw a little bit of infrastructure announced in the federal budget, although the numbers are fairly muted. There's already quite a few infrastructure projects underway that are all about connecting some of the sort of close regions to the cities. But I've got a thesis that I want to run by you guys. Now, we said that we didn't want to be too Melbourne-centric, so I've got some parallels in New South Wales. We're talking about Melbourne and its potential to grow. Once we see green shoots in Melbourne, is there an opportunity to move to one of the adjacent regions? Because I've always observed the correlation between the Sydney market and the Newcastle market. It's almost like whatever happens in Sydney, within 6 or 9 months, you'll see that in Newcastle. You could probably throw Wollongong into the same packet there as well, a bit further down the coast. And I think we've seen that in places like, I always forget the Bendigo or Ballarat, which one's the close one? I think it's Ballarat, right?
Ballarat's closer, but it's actually the Geelong. Geelong agents will say, when Melbourne does something, we're 6 months behind, and that's a pretty well-known path that they've trodden on a few occasions.
Is it still true? Like for people that, the price point is different, right? Investing in Melbourne's going to cost you a lot more than it is in Geelong. But for people that are kind of thinking, oh, should I wait? Well, is it a bit of a safer strategy to wait, watch Melbourne post the numbers that you guys have both promised are going to happen, and then jump straight into Geelong?
Well,
Right.
It'd be an interesting thesis to run. I'd love to say yes, because anecdotally I've seen a few cycles do just that. But I think I'd want data before I was recommending or backing myself to go and do something like that. But I think it's a good premise, Mike.
Yeah, I reckon let's just start a unit trust. We'll have a whip round and the three of us will test the thesis ourselves. What do you reckon?
Well,
Dave, what do you reckon?
I'm up for it. I think anecdotally that it will ring true, that thesis. Now, whether I doubt it's probably 100% of the time, but if it's 80 to 90% of the time, you probably can move forward with a pretty confident. It wouldn't be that hard to do to find the data.
No, it wouldn't.
On either. It's actually,
We did FCE in the same year, Dave, and I think we both studied what they call methods now, change and approximation, the calculus and all of the trends.
Change and approximation extensions.
Yeah. Remember one of those exams, we called them CATs, then the kids all call them SACs now, and they had all of the weather patterns from WA and then South Australia, and then they gave you a range of, Melburnian historical weather days as well. And the task was to determine whether there was direct correlation between the Western weather. Do you remember that one?
No, were we 1 year apart?
We might.
When we
Oh yeah,
finished?
I finished in '92.
Yeah, I was a year after.
Gotcha. All right. Well, if we could do that in year 12, we can do it now.
Yeah.
Well, you heard it here first, kids. And let's see if we can patent this, and we'll claim 1% off the top of everyone's capital growth, and we'll be squillionaires.
One of my assignments I remember was on reasoning and data and TAC stats and the assessment of that, why it's how much of a higher risk it is for riding on a motorcycle versus driving in a car and doing all the numbers.
Oh, you've got to love the Victorian Education Department. Double message there.
It's a good one. It was much more dangerous riding motorbikes. That's
going to say that's why I haven't seen you on a motorbike then, Dave.
Yeah.
All right, let's talk about rents. Annual change in rents. We can see houses versus units. Obviously, we saw from a capital growth point of view in the 3 month to April, units were doing better than houses almost everywhere. When it comes to rents, it's kind of like a similar story. It's a little bit closer to parity, but say, for example, Perth leading the charge at 13.3% annual change in rents for houses. It's 15.5 in units. Melbourne's gone a little bit the other way. Sydney 9.2 in houses, 8.7 in units. So, yeah, it does kind of seem like rents across the board are fairly kind of stable, house versus units, but it's just really that capital growth where we're seeing the change. So rental yields are a little bit better for the units.
I concur with you, Mike. If I look at the ones that on their run peaked higher as units than houses, it was Sydney and Melbourne. Perth is the same. So we're seeing Perth still on its up trajectory here with its rental growth. And I know it's a fuzzy little line there with houses, but it doesn't look like Perth has come off yet. And as I pointed out, we were chatting about this yesterday, the rate of increase has come off, but they're still all increasing. I mean, the only ones that are sitting below zero at the moment is Hobart. Everything else is still tracking positively. You could argue that Canberra's pretty static, but it's above the zero line. So we've still got rents moving upwards, just not at the same crazy pace as they were 6 months ago, except for Perth.
Yeah, and look, Hobart's on the way up there as well. So it's about to crack. If that's just under, it might have even just got above 0.3%. So, I mean, nationally the rents were up 0.8% in April, which was slightly below the previous 2 months, which were 0.9 and 1%. So
still a lot, isn't it? It's close to 1% per month.
Nearly 10%. So we're seeing like it's sitting around a level at this stage, isn't it? You could make a case that it's slightly paring back, but it's not much. You'd need to see that happen for another 1 to 2 months, I think, for that to call it an actual trend.
Nationally, if we just iron out everything and average the lot, we're looking at 8.5%, and that's huge. That's certainly outstripping our capital growth in Melbourne, but that's a big, strong figure. And if that was sustained, tenants would be aching in a couple of years.
In macro terms, the 12 months to April, we see annual change in rents at 8.5%. Now, this, I've got to say, I'm really happy with that, because I think in the beginning of the year, one of my predictions for 2024 is that rents wouldn't grow as quickly, not because of fundamentals, but because of behaviour, where people are deciding to share rooms, and just there's only so much people can afford. So, gosh, I hope that trend continues, because I think the rest of my predictions were probably absolute garbage.
Well, we might see it jump up again, because the government are about to throw another $1.9 billion into households to put towards rent.
Yes, the Commonwealth rent assistance is, I think they're giving an extra 10% in the cap for the payment there. So, I mean,
which will equal $1.9 billion. Into inflation.
Yeah, it's an interesting one, isn't it? I watched Chalmers get grilled this morning about the non-means tested electricity bill rebate thing. So basically everyone's getting $300, whether you earn nothing or $1 million a year. And I kind of thought that was a bit bizarre that wasn't means tested. But as far as I'm aware, like his rationale for that is that it would have been too complicated to means test that. The mechanism that they're using is it's just going straight through the electricity providers who don't have that ATO data, so they can't sort of make that connection. Is that, do you reckon that's a real thing, or is that just kind of laziness? We're just like, let's just give everyone $300 instead of having to grab this data. Surely we can match the household and the individual to their previous year's tax return and distribute it properly, because otherwise it is just inflationary, right?
Well, there's two parts to that question. There's two answers. The first one is, will it be a popular voting tool? Because we're talking about politicians. But the other one is the cost of compliance and control around means testing. You'd like to think that they've got some established systems that could make it pretty straightforward. But if we're talking about subjecting the offer to more scrutiny and obviously more bureaucrats and systems and processes, it might have been determined to be a really expensive initiative if they did that. I don't know. I'd be fascinated to know what the rationale was.
I think one of the upsides of that approach is it's not $300 that people can just spend. It's being deducted from their energy bill. So they're hoping that a large percentage of people won't then just automatically go and spend that extra $300. But, a fair chunk of the population will. So it's going to be inflationary. It's a matter of it's debatable how inflationary it will be. And then I guess, it's like, well, how much time and money would it cost to actually pay people to figure out means tested and how accurate would that be? And, then how many people might have complaining because they didn't get it when they should have and other people got it when they shouldn't have? And could it end up having negative political, swing back when it was meant to, obviously one hand it's helping people, the other hand it's trying to get votes. Yeah. So, as they talk all those things through, they probably and then also there's a lot of the population who don't want it to feel like Big Brother, where it's that easy for the government to go, okay, everyone's earning this and everyone's electricity bills that, and match all their, different pieces of their personal life together to then be able to come up with a simple solution. I mean, a lot of the population don't want that to be the case either. Although
they passed it off a little bit by saying, it's tricky, but also, we want to sort of respect the fact that Middle Australia is hurting as well. Cost of living pressure. That sounds a bit convenient, but I guess proof that bureaucrats waste money and can be inefficient is the $78 million in the budget to present the business case for Sydney to Newcastle high-speed rail. Like, I just kind of think, gosh, there's consultants just rubbing their hands together. You're like, $78 million, and we don't have to build anything. Just make a PDF to say, we could do it.
Do you reckon it involves requests for quotes and tenders? And
you'd hope so.
Yeah,
you'd hope so.
Still, 78, it's a lot, isn't it?
Well, what about the fact we've just handed $1 billion to a quantum computing company who isn't even based in Australia? A large chunk of their shareholders are American-based. It's in Silicon Valley, and there's no transparency around how we've made that decision, and why we've chosen this one particular company and put so much money into one particular company and approach to quantum physics.
I tell you what, if that computer can't figure out the correlation, if that computer can't figure out the correlation between, say, Sydney, Newcastle, and Melbourne, Geelong, then there's something wrong. But maybe, I don't know if they take requests, but we'll get them to crunch the numbers on that one. Let's have a look at vacancy rates hot off the press. No, they've got to build the thing.
See in 10 years.
Yeah.
If they win the race.
Hot off the press vacancy rates, March 2024 vacancy rate of 1%. Compared to, say, April 2023 at 1.2%, April 1.1%. So, a slight little increase there, but nothing too material. I mean, the fact remains we are still in a national rental affordability crisis, and what was in the budget for renters only those on Commonwealth rental assistance. The vast majority, I assume, don't have access to that, and there was no real relief for renters at all.
No.
Yeah. What it was interesting was, and look, at Darwin's such a small capital city that the numbers can skew at times from month to month, so we'd need to see this last a bit longer. But Darwin was the only capital city that actually reduced its vacancy rate. All the others stayed at the same level, or the vacancy rate actually rose. So Darwin fell 0.3 down to 1.1. And we also had Darwin as, again, most of the capital city property values were very similar to the previous month, except for Darwin. So Darwin rose 0.8% in growth for the month. So it was minus 0.2% in March and jumped up by, when prices grew by 0.6% in April. So maybe there's a little interconnection there. Maybe they're early little signs of something happening in Darwin, but it's just 1 month. But that they were a couple of things that sort of I picked up.
Yeah. I've looked at the rental yields between the capital cities and that state's combined regions. And what is interesting is that that gap has tightened for quite a few. There used to be quite a differential, and the capital cities are catching up.
It's interesting to note that the Commonwealth Rental Assistance apparently is going to help 623,000 private renters. How many renters would there be in Australia? Maybe like 3 million, something like that, as a rough guess. So to help that small cohort, it's $1 billion added to the federal budget. You contrast that to, say, negative gearing losses. I mean, we talked about in 2021, there were actually no net losses by renters. But if you go back a couple of years, the average is around about 3.6 billion. It just goes to show how expensive it is to help renters to be able to afford increase in rents, but how actually cheap it is to support landlords that are providing that rental accommodation that bring the prices down. That's probably not a very popular comment. You're not going to hear that in the House of Representatives. But
yeah, Adam Bant's not
honestly,
grabbing that. That's
well, it's a great
grab.
point, Mike. It's a really good point. You've just done a little bit of Googling. I have as
I can
well.
hear you clicking away.
2.4 million households renting as of the 2nd of Jan 24. So if this rental assistance is going to help 600,000 households, you've just said, that's 25% of renters. That's a huge chunk of the rental population that we're giving money to. And that is a big part of the inflation basket as well.
rent.
Now, you're not including
social
social housing, are you, Dave? I believe that the rental assistance also supports people in social housing.
Yes, good point.
Yeah, well, thanks, Dave. I'm always here to speak truth to power. It's one thing I want to give a bit of an insight. We are actually working on internally a research project looking at the housing costs per marginal federal seat, because I think housing will be an election battleground in some way, shape or form. And there's quite a few marginal seats where the cohort of people in designated kind of rental stress is quite high. So that's something I actually wouldn't mind unpacking in a future episode, because we know that the election's likely to be between now and this time next year. I think, gosh, many of us don't have the stomach for a 12-month election campaign. But essentially, it started last night with the budget, right? That was a budget. That was an election budget.
Ring the bell. That's the start of the first quarter.
Yeah.
I just Googled. There's about 300,000 who get housing assistance, so that would take it up to 2.7. So I'd say about 20-ish% helping 20, and even if of those 600,000 who are getting assistance from the federal budget, let's say all 300,000 go to those who are in government housing. That would mean about 1 in 8 renters are getting support. I
Yeah.
think it feels like it's still a very high number when it's 1 in 8 of everyone renting, plus assuming it's every single person who gets assistance from the government. It's throwing a lot of money at renters and I'm not saying we shouldn't throw some money at renters, but again, the bigger problem is supply, isn't
Yeah.
it?
Yep. And we can see from the prop track data the amount of investors that have sold their property in the last little while. And we can see from state intervention, the percentage of people buying in Queensland dropped when their legislation had its time in the sun with Victoria. I crunched some numbers and saw that Victoria's really galloped its way to the bottom in terms of preference for investors. You know, that's what
We've
happens
been
when we
pulling
have
hard
this.
on those reins.
Let's talk about listings. It's interesting to note there's kind of two stories here. In the 4 weeks to May the 5th, new listings, we've basically seen sort of a slight uptick. The 4-week count of new listings is 18.3% above this time last year and 13.7% higher than the previous 5-year average. Now that's new listings, but when you look at listings in total, we're about 18.2% below the previous 5-year average. So listings are coming, but historically
Yeah.
they're still quite low.
Absolutely. What this tells us is that this year and in 2022, we had decent new listing numbers. So the listings over the course of the year were of reasonable number. Last year, however, we had less listings in the first half of the year, and then we started to catch up in the second half. But what we're seeing is total listings, they're all getting soaked up. So the old listings, the stuff that's been floating around for a long time, that's getting purchased. And we could put that down to a few things, but dare I say it, when we look at the value growth that we've seen in units versus houses, I think a lot of the units that were floating around and languishing and not appealing to people have been getting picked up. And we're seeing that in our listing figures when our overall listings are 18.2% under the traditional 5-year average.
Yeah, and look, I've spoken about this before, but part of the problems with this graph is we're assuming the population is static, and it's
Yeah.
not. So we're looking at a 5-year average, and probably what's happening is the population's growing. New listings are growing as they should because we've got more people, but because we've got more people, they're buying more property, and therefore the total listings average is sitting lower than the 5-year because the larger population is buying more properties as they should. But really, we should be factoring the population growth and increasing the 5-year averages to where things really should be sitting relative to the actual population, as opposed to where it was historically.
So there you have it, Core Logic. We need you to index it for us.
Yeah, but it'd be nice because I don't know if you'd noticed, but we've had quite a few new entrants in the last financial year. I was going to agree with you. I think I'm going to agree with you, Kate. Those graphs said to me it's a days on market story.
Yeah.
If you look at the 12 months to April, it was 44 days on market, which is actually 9 days longer than the previous year, but down from 64 days in 2019. So it does kind of seem like some of the less desirable things are being mopped up by demand just because people aren't spoiled for choice.
And let's even talk further
There's
about
more
that. Not
people.
necessarily less desirable. Items that were less desirable 2-3 years ago, but desirable now. And I'm circling units again.
Yeah.
Units have certainly had a real renaissance. And I guess when we're talking about a high interest rate environment, or as the RBA would like to call it, a more historically average interest rate environment, the borrowing capacity is diminished, right? And that feeds into units. I mean, we know from our data that the average purchase price is $650K in the last financial year. If you remove outliers, because sometimes we have people buying $10 million units, it's closer to $550. And we heard from Jeremy, the accountant, who works with a lot of buyers agents last night, saying that, you know, a lot of investors are buying in that $300,000 to $400,000 mark. And it begs the question, what can you get? Well, units more than houses, right?
Yeah.
Absolutely.
And it all could be as simple as we have more people and less supply.
Yes. Yeah. I did take your point on that, Dave. I'm not going to argue. We've had a lot of people galloping their way into the country. Let's talk about consumer confidence. We don't have Westpac to reference. That's essentially a couple of months old, but we've got the Roy Morgan consumer confidence, and sometimes it's nice to take the pulse of a slightly different measure of the same sorts of themes. What were the takeaways for you guys from the ANZ Roy Morgan consumer confidence data?
Not a lot of change. And we've said the same thing about Westpac over the last 2 months as well. Nothing significant.
No, it's pretty much pretty consistent. Slightly fell. I imagine that's linked to the RBA sharing that they did discuss rate rises. They did not discuss a rate reduction. Now that might have been missed in some of the headlines and noise, but that came up in a question in the chat that Governor Bullock does now in the press conference after each meeting. ABC journalist asked that question, and she shared that information. So, I think just that higher for longer reality setting in is probably going to keep consumer confidence flatter.
Yeah. The time to buy a major household item did come down 4.4 points, and that's not insignificant. It's not smashing records, but it's certainly showing that something's going on and affordability is biting.
You look at consumer confidence and, the last, let's say, 2 years, we're kind of tracking around about 60% of where we were between 2014 and essentially COVID. So we are still a little bit depressed about our lot in life financially.
Yeah, and I think we can almost boil that down to interest rates. And people are getting used to higher rates for longer, and this being the new norm. And that might take, well, it'll be interesting to see how long that takes to play out before people adjust and realise this is where rates ballpark are probably going to sit for I think for many years to come. We might have a little bit of a drop at some point, but I feel like this level is here to stay.
Yeah. Isn't it incredible that 11 years of consecutive falls in the interest rate or the cash rate, and then historically low levels? 11 years, obviously it's a long time for someone who's in their 20s. It's representing potentially half of their lifetime. But for our age and older, 11 years shouldn't be enough to set a new expectation of the new norm. However, it did for a lot of people, whereas historically we are in normal territory now.
Yeah, exactly.
Yeah, it's funny when you look at the beautiful Australian real estate graphs that go back, to the early 1900s. It's every sort of blip becomes really minuscule, but when you're in it and you're living it, it feels really, really real to you in that point in time.
Yeah.
Let's talk about lending. If we look at the data that was published on the 8th of April, up 31% for investor activity, 11% owner-occupier, but you sort of protract that over the historical average. It's not like there's an absolute boom in investment. It just kind of, it's just a big print on the previous year.
Yeah. My frustration with our ABS data, unfortunately, is that we don't get it in real time. The ABS portal tend to get away with having us lagged a little bit. So I'm looking forward to our next market update when we cover off May, and we'll be privy to some new information about investor lending, because I think that is one to watch.
Now, Kate, I will hand over to Dave to discuss some of these APRA graphs on housing credit, but one that you kind of zeroed in on is the percentage of loans originating with an LVR greater than 90%. I know that one kind of caught your eye. What have you observed there?
Oh, look, they all tumbled down following our credit crunch, and it was intended. APRA absolutely wanted us to all buckle in and have more household savings and reduce our debt balances and, get away from dangerous territory because
Fund
there was bubble
police,
talk.
APRA.
Yeah. And as we all know, Dave would know this the most, our lending rates for higher LVRs between owner-occupiers and investors are very different. And that's absolutely showing in the data here. And when we look at the percentage of loans originated with an LVR equal to or greater than 90%, we're seeing that has come down, but it's still more than double the number of owner-occupiers that are in that space than investors. And all of these charts say to me that we're not in dangerous territory with overreaching.
No.
Actually seems, Dave, like there's a bit of a credit crunch looking at the graphs.
Yeah, I think what's been happening is we haven't know how far rates were going to go up. And so lenders and everyone's winding in their policies because they're really concerned. If I lend money to people at this point in time, and we've got a buffer built into how much they can afford to borrow, but rates go above that, then we could have lots of arrears and troublesome debts. Now, it hasn't turned out like that, and we are much more confident that we give or take, we're near the top. So what we're seeing there in maybe a couple of those numbers is we're seeing lenders just starting to wind in their policies and become slightly more flexible to free up a bit more financing, because we feel like, okay, well, if people are paying 6.5%, 7% on interest rates, and we're building in, therefore servicing them off 9.5%, 10% rates for affordability, we don't think rates are going to get that high, so we can be more confident in the approach we're taking to serviceability. So I think that's a little bit of what we're seeing in those graphs.
I think if we talk about the budget and the outcome, at the mid-December review, they were predicting a deficit. We actually we have a surplus of just over $9 billion. And for me, it comes down to two things, unemployment and commodities. So unemployment, their prediction was 4.25%. Obviously, it's sitting at 3.9%. So there's less welfare payments and there's more tax revenue from employed people. And then when it comes to iron ore, metallurgical coal, and what's the other coal? The coking coal for energy. Really, the prices that were in that estimate are about half of what they really are. So Chalmers has been given a real gift there. I mean, they're predicting a deficit of 24, 25 billion next year. That kind of is the macro takeaway for me. Dave, how have the markets really reacted that? We saw the Australian dollar last night, up marginally, bonds up a little bit, but it's kind of business as usual, would you say?
Yeah. Look, I think the 3-year bond yield had already started to bump up. It hasn't done too much. Today, it's gone up a little bit with the stimulatory impact of the budget, but we're looking at around 4%, but it was already sort of being factored in that rates were likely to be high for longer, and people are betting that it's more likely that there will be a rate rise than a rate reduction in the near term. Not that there's any guarantee that there will be a rate rise, but so look, I guess it fed into the narrative that already existed that, if anything, we've sort of now tilting towards a rate rise rather than a rate fall as the next move.
And that seems to be the real election battleground. If interest rates aren't down by the next election, we could have a change of government. Anyway, that was April's results. That was our quick budget overview. It's time for the gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
My gold nugget is to keep an eye on units. And I'm not saying that one data point represents a trend line, but I think we've got a few compelling reasons why people could be circling units. And there are some markets where I think the performance of units won't disappoint. So that's one I'm going to keep a very close eye on, Mike.
Look, interesting your point in terms of how they underestimate the actual price of iron ore, for example. I think it's often around $55 in the budget. Then it comes out the average price across the year was like $107. And so they've got this huge windfall that they almost can bake in. And I saw an interesting graph over, I think it was like the last 2 decades, comparing us to other similar nations who have a large part of their economy being mining. Our terms of trade, in terms of our exports versus imports, was like off the charts, the most beneficial of any country in the world over the last 2 decades. The problem is we haven't been saving that money. We've been spending it,
Yeah.
and we don't have a lot to show for it. And, I think that's going to be the big challenge going forward is we sort of, we want so much from our government and we're so used to having it so good. But we need to start setting aside some of this money. Otherwise, as they say, when the rainy day arrives, we're gonna be in real strife.
Yes, the future fund we need to chip into. Well, guys, some great gold nuggets and a great wrap of the April figures and the budget figures. We're eagerly awaiting Melbourne's charge in the next couple of releases. But it'll be interesting to see.
I'd say hold your breath for 12 to 18 months.
Yeah, we'll be right. It's just a matter of timing. All right, guys, thank you very much. We'll see you next week.
Good to see you both.
See you later.
Bye.